Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I have with me Jess Rusit from FIIG Securities. She's an investment strategy specialist. Welcome, Jess.
Thanks, Liz, for having me. How are you?
I'm very well. Delighted that you could be here. So we've got all this interest in fixed income at the moment with higher interest rates, meaning it's much more attractive. Tell me, why would people choose to invest in bonds direct?
Sure, Liz, this would probably be one of the most frequently asked questions we get at a lot of the seminars we get from potential clients and investors that come along. And I suppose the biggest difference really does come down to what sort of investor you actually are. So if you're someone that likes to hand over that control and the decision making and put that in the hands of the portfolio manager, then an ETF is probably more better suited to you. But if you like to maintain control and have that, power over the decision making of your portfolio, then direct ownership is probably more up your alley. So the biggest thing that comes of having control is that you're able to build your own portfolio, and with that you can have something to meet your investment goals, your own target yield. If there's a particular income that you would like to receive over a particular amount of time, that's that flexibility that a direct ownership can give you. You can also have then a portfolio that better suits your risk appetite as well. So if you have a low risk, you can have something a bit more conservative. If you have higher risk, then you can build something that better meets those needs as well. The other thing too, you can make those decisions around, buying and holding yourself. And with that comes, which we will get down and talk more to, that ability to trade, make capital gains as well. Another benefit of it is also diversification. So when you're in a managed fund or an ETF, as you mentioned, you are investing in a whole portfolio. You may not know everything that's actually held in that. Some of these ETFs may be transparent for the top 10 holdings or whatnot, but beyond that, you're not really quite sure. And you're having this as part of your portfolio across, you may have shares, property as well. And then you don't really know what's held in this ETF or this managed fund. So there might be an overexposure to banks in there, but you also have a big holding in your share portfolio of that. Whereas when you have the direct ownership, you can build that. So you might want to dial down your bank ownership or dial up infrastructure or something like that, whereas you don't have that transparency and diversification that you can see with an ETF. Another benefit too is really with an ETF, you really have to be across what benchmark it is tracking as well. And you may not have that flexibility in terms of what those market conditions are. So for an example, an ETF might track the 7 to 12 year government bonds. And with that, at the moment, with, as you mentioned, rising rate environment, you've got a little bit of duration, and that's your sensitivity to interest rate movements. So the performance may not have been great this past year as interest rates have moved higher. Whereas with direct ownership, very quickly you can swap out of position. So you may have a view that interest rates are going to move higher again, or that we may see interest rates being cut, and you can very easily tailor that portfolio with a very quick turnaround time to then match your outlook on interest rates or market conditions. Whereas for an ETF, you would actually be selling down and exiting that position completely and then finding another one to move into. And then the other thing behind that as well is your fees. Some of these ETFs and managed funds, you've really got to read that small print to better understand what sort of fees you're dealing with. With direct ownership, it's buy-sell spread, as we call it. So every time you sell and buy, and we're very transparent with that, it's about 1 to 1.5%, even less than that, depending what the actual bond is. And also we have cut fees as well. But that's the extent of it, and that's all on our website, so it is quite transparent and accessible for investors to read.
Okay, so if the investors are new and thinking about investing direct with the ASX or with shares, they go to the market and they can see all the shares available and where they're trading, etc. And that's also a reason possibly investors like listed hybrids. So how would a corporate bond portfolio or bond portfolio compare to like a listed hybrid, like maybe like the CBA Pearls?
Sure. You mentioned ASX and direct ownership. And on that note, I might just touch on the over-the-counter market, which is how we refer to where direct ownership is bonds are actually traded. And we refer to it as OTC. So the over-the-counter market, and like you said, it isn't as well known as the ASX. And so because of it, there's lots around it that, it seems to be a bit unknown and confusing, which certainly is not the case at all. OTC market is, like you said, there's no exchange for it at all. It's a market of buyers and sellers. So you could say it's similar to the property market where you've got buyers and sellers coming along. It is massive. So the bond market, there's about $2 trillion in outstanding bonds. So it's actually bigger than the ASX market. And it's for that, to access that, you also need a broker, which I suppose that is essentially the role that FIIG plays with that as well. So that's OTC. So we have 6,000 clients, and then there's external market, $2 trillion, and it's a very liquid, deep pool, very accessible. So you mentioned the hybrids, which always get quite a lot of attention. They're from major banks, and the returns seem quite attractive, and they always do get quite a lot of attention. The funny thing is, though, with this, we have found there has been recently, a trend in terms of the value that they offer compared to bonds offered in the over-the-counter market, or OTC, as I will refer to it. And that very much is that those pearls issued, and they were issued in a spread of 2.85% over the bank bill swap rate. At around the same time, Tier 2 bond, which is just a step up in the bank structure for a major bank. This is a safer position in the bank's capital structure. It also trades less volatile than what a hybrid does on the ASX market as well. And on that, around about the same time that the pearls issued, there was a Rabobank issuance, and that was at 2.95% issue spread. So it's a wider margin, more attractive return. It was actually short for a shorter tenor as well. So it was shorter dated than that pearls. So it provided more attractive value for a safer position as well. So as much as the hybrid and the transparency in the listed market does get a lot more recognition, and certainly investors, it seems a lot more appealing, there's a lot more relative value on offer in that OTC market that investors should be aware of as well.
That sort of leads me to my next question really nicely. We talk about corporate bonds, and in our world, we often talk about spreads, but we don't talk about whole rates of return. Could you perhaps give us some examples of corporate bonds and whole rates of return? I think really a lot of new investors see government bond rates, and the 10-year government bond rate's about 3.7% and think, oh, well, I'm not going to invest there because 3.7% I can do better with a deposit, like a term deposit. So perhaps if you could just explain some of what's available or what you're seeing at the moment, that would be great, Jess.
Yeah, certainly, Liz. So you mentioned government bonds, and we certainly do provide access to government bonds, and in a balanced portfolio, they certainly do have a place to pay in terms of their defensive nature. And, with rates high, they also do have, at the moment, relatively more attractive returns. But yes, as you say, they are very high rated credit quality. And as a result, the returns aren't that attractive, especially with inflation and whatnot going on at the moment for, investors trying to earn a decent return. So there have been some new issuances, and just to kind of give you a feel of what is coming to the market at the moment, where we have interest rates at the moment, there was a recent issuance from Transgrid and AusNet. So people will be very familiar with these. They're household names. They are both investment grade, strong utilities exposure, and to give some indication, the Transgrid was a 7-year bond, and that was issued at a coupon of 5.77%. And the AusNet was a 10-year bond, so it's a little bit longer with a 2033 maturity, and that was at a coupon of 6.134%. So that's quite attractive for these investment grade bonds. The other thing I'll just mention, they were issued in the primary market. So when a bond is first issued, it comes to market in what we call primary. So let's think of that as an equivalent of a share coming, and it's an IPO. And then once it has actually launched and settled in that primary market, and then it begins trading. So you've got note holders selling and new investors coming to the market and buying that. That is then called the secondary market. So those are the two issuance that were recent for the primary market. If I have a look at what's available in the secondary market, there's Pacific National, and once again, another household name. It's investment grade as well. It's a strong infrastructure exposure, and that's available at a return of 6.8%, and that has a maturity of 2031. So these are quite attractive returns, paying higher coupons and providing a really nice cash flow for investors at the moment.
So Jess, I'm assuming all those bonds are fixed rate. Is that right?
Yes, right. And just to stipulate, you're right there. And so there are different types of bonds available in the market. Those are fixed rate, which we have a preference for at this point in time, just with our outlook in terms of interest rates at the moment. It's a really attractive opportunity, a window of opportunity at the moment to lock in those high rates while they're being issued and available at these higher levels. So those are all fixed rate. Another type of bond is a floating rate note, and that pays a margin over benchmark. And this benchmark is essentially, as the name says, floating rate. So the margin's fixed, but the benchmark, which is BBSW or bank bill swap rate, that will change and move around with the market conditions, the market outlook. And so because of that, it has less sensitivity and less movement in terms of what interest rates are going. So you want your fixed rate in your portfolio. You also want your floating rate because of that particular nature, that it doesn't have as much duration in it and sensitivity to interest rates. One in particular we like at the moment is issued from the Commonwealth Bank, and that pays a fixed margin of 2.70% over BBSW. So at the moment, that coupon's around 6% each quarter, and that's quite attractive. Once again, when you think interest rates are going to be cut, that bank bill swap rate, BBSW, is going to move later, but you're still going to receive that margin of 2.7% over whatever the benchmark is, which still does provide an attractive cash flow. That bond has a call date in 2033, so it provides a long-term, regular, stable income stream for investors. And the other type of bond that you can access in the direct market is an inflation-linked bond, and there's two types of those. There's the CIB and also the IAB. The difference between those is the index annuity bond pays an annuity stream that is indexed to inflation. So it will move in step with inflation, as does the CIB, but the difference is an IAB will also pay back some capital along the way, whereas this isn't the case for your CIB, which you receive that lump sum come the maturity date. And once again, with concerns around inflation, those bonds are really also important in a portfolio. Irrespective if inflation's actually moving up or not, they are higher credit rating bonds. They're mostly infrastructure exposures, and those cash flows generally are backed by a state government project, let it be a hospital, schools, those sorts of key infrastructure projects. So they're also an important piece to have in a portfolio. And so that's why we talk about flexibility and being able to build your own portfolio. You have that whole range of them, and there you're able to tailor it for different market conditions, whatever your outlook is in terms of interest rates, and also what return you'd like to achieve.
So, Jess, we hear that the US might go into a recession, and while we don't think it's going to happen here, what happens to bonds in a recession? And of course, there are different levels of risk in bonds, so I imagine there's different possibilities depending where you are on that risk spectrum.
Yeah, that's right. And I suppose just taking a step back, and I'll give you a little bit of background of how the investors behave and whatnot during those recessionary times. Economic instability and market jitters and whatnot, especially what we have seen over the last year or so, is that investors want to move out of their riskier exposures in their portfolios. So they've got concerns that it may not perform well, for either capital losses, that dividends may be cut. So you'll generally see weakness in the share market. You'll see investors trying to sell some of those exposures. And then they'll move into what they would perceive as more of a safe haven exposure. And those are the likes of government bonds, okay? And these are your AAA rated, or for Australia, top of your capital stack and top of your credit ratings as well. And that has a flow-on effect down to your other bonds as well. So if you stay in that investment grade exposure in your bonds, they perform quite well. So when you spoke about the different types of risk, as you move down your capital structure of a company and also of a bank, and also credit rating as well, you will see more credit spread in there. And what I refer to as that is the premium that investors ask for to be compensated and paid for the perceived risk in what they're actually holding. So with a government bond in Australia, AAA rated, it's considered a risk-free rate. So as you're moving down, so say you're holding a BBB rated bond, then it's that premium over your risk-free rate. And so there's a little bit of a credit spread that during times of economic instability that they will move wider, but that demand for safe haven bonds and that yield compression will see yields move lower, and as a result of that, those capital prices improve. So that part of your portfolio, in particular, your fixed rate bonds, your investment grade, as I mentioned, your AusNet, your Transgrid, Pacific National, these strong infrastructure or utilities exposures with strong credit ratings, they perform quite well. The other thing I talk to is also credit ratings as well, which also comes into the piece as well. And there hasn't been, it's investment grade ratings, the defaults are very low. S&P, which is a credit rating agency, there's also Moody's and Fitch as well, they release an average default rate per rating each year. And it's a table that actually shows your chances of default per investment grade rating, and also the time horizon for that as well. So I'm just looking at this now. It's accessible on the S&P website, so investors certainly can access it. But if I just, for argument's sake, have a look at an A-rated bond with a 5-year tenor, it has a 0.44% probability of default, which is really quite low.
It's so low. It's so attractive. I mean, that low risk is, I think, one of the greatest benefits of the asset class. There's such a diversity in the range of bonds that investors can tap into, whether they're concerned about a recession, whether they're concerned about inflation, whether they just want yield. There is, I think that is one of the benefits, or there's some of the benefits of going and investing in direct. The downturn, we've had downturns. I think what I wanted to say really was that when you see those price appreciations in government bonds or investment grade bonds, that's when, if you need to, you can sell, make a profit, and that offsets the losses perhaps in your share portfolio or your property portfolio. So it is defensive asset class that counters those higher risk asset classes. I did want to just talk to Jess about liquidity, because I think that's really important. Australians love property, but if you want to sell a property quickly, you're going to have to drop your price pretty quickly.
Not so much in this market, Liz.
Not so much in this market, but in a recession, if we have a recession, and interest rates do get up. I remember when they were 17%, mortgage rates hit 17%. I can't imagine what, Australian homeowners would do if they thought we'd even get to 10%. But perhaps if you want to talk a little bit about liquidity in the bond market, that's always an important question to discuss, I think.
Yeah, and I think also it's relevant where you've got investors that are so used to an exchange, holding a share portfolio and having that transparency and being able to see it. And I think they feel that they need to actually have an exchange in front of them to really kind of understand that there is liquidity. Liquidity does exist, and it doesn't have to be on an exchange. As I did mention before, The OTC market is 2 trillion in size, so it's quite deep. And we also do trade as well in, or you can access the USD market as well, or other currencies as well. So, and that's another thing, I suppose, you can have a particular view on the US economy. And so you might think, the Australian economy is lagging, we're a bit behind them, they're ahead of it. So you may want to, have an exposure over there. And so, that provides another level of liquidity too. At FIIG, we have 6,000 clients as well. So even amongst our own client base, there's a lot of trading that goes on as well. Like you said, it really does depend, on the market and what the market conditions are, types of bonds you are holding. But generally, having an investment grade bond, you're going to have a very quick turnaround. On our website, there is indicative pricing, and that shows the close of day, the day prior. So you can have access to that. There is also a relationship manager that you have access to call that can give you, on the spot pricing. And if you are, like I said, if it's an investment grade bond that you're looking to sell. And the other thing I will make the point to as well is that you have a diversified portfolio. So you've got your fixed, floating, inflation linked, diverse sectors, different maturity dates, and they are all going to perform differently within that portfolio. And that's the whole point of it, that you can call on any different exposure at any different market condition if you need liquidity, should you need cash or whatnot. That is the beauty of having a very well constructed portfolio.
Excellent. So moving on, I'm just wondering, if I'm looking to invest and I would like a portfolio, what's the minimum investment per bond and the minimum investment for a portfolio, and how many bonds would you typically suggest made up that portfolio? If you could give us an idea of what that might look like and what sort of returns I might hope to achieve, that would be great.
Yeah, sure. So you can start a portfolio from $50,000, just to give some indication. But we really do see a better diversified portfolio when the amount is $250,000. And with that, you have a wider range of bonds and portfolios with it more evenly split. And I'll talk through some sample portfolios that we have just to give an indication of why we say $250,000. But certainly from $50,000, you can start to have your a portfolio of direct bonds set up. And these bonds can generally be broken down to parcels of $10,000. So when we say $50,000, you can hold 5 bonds there. Maybe not the great level of diversification, but certainly it's a great starting lot. And, to have 5 of them, that you certainly will have some range of tenors and exposures within that. On our website, which anyone can access, we actually have some sample portfolios. So I might actually just talk through them because, the whole point of these portfolios, which are updated monthly, is that they are relevant. They've got bonds in there that anyone that comes through, with direct ownership can access. So they're very realistic in terms of how we would recommend setting up a portfolio and also what are some realistic returns and what it actually looks like. So we have, and this is where it comes back to my first point where we spoke about, having control over a portfolio and what your risk appetite is that these sample portfolios, we split them out between conservative, balanced and high risk. And as a result of that, you'll see, I'll just briefly talk through the exposures in there, but what you'll find is the returns on the high risk are higher. They're a bit more juicier. And the more conservative one is a little bit lower, but you would still agree that it's quite attractive. And then your balance is a mixture of conservative with some selective high yield exposures in there. And also we keep those high yield ones in that portfolio to more smaller portions of that overall portfolio as well, because it's balanced. We don't want to take on too much risk, so they're in smaller parcel size in comparison to your overall portfolio. So just looking at the balanced portfolio, that one has 16 bonds. That is on a spend of $600,000, and that's just for an example. That has a yield of 7.48%, and the 62% allocation is to investment grade. So you can see more than half of that, you've got an investment grade. And then the high yield portion of that, so it would be sub-investment grade or unrated. And when I talk about unrated, those are issuers that have launched bonds in the market, but they haven't actually gone to your likes of S&P, Moody's or Fitch to actually access a rating on it. So it's not to say it would be sub-investment grade, but they just, for whatever reason, haven't gone ahead and gotten a rating for those bonds. So the bonds that we actually have in a balanced portfolio. The Sydney Airport, and this is an inflation-linked bond that I was talking about earlier, that has a yield to maturity of 5.28%, and the cash flow on that, as I did speak to earlier, Liz, keeps step with inflation. So that's really, I suppose, at this point in time where we've got inflation, although it's creeping lower, it is still elevated. That's going to really help out keeping your return in step, or with the inflationary pressures at the moment. We also have Challenger Life, which is the life insurance company, and that has a 2027 call date on that, and that has a return of 5.64%. And also in this portfolio, we have an unrated bond, and it's called Race, and that has a return of 9.91%. So you can see, and sorry, that has a 2027 maturity on that one. So you can see there's quite a different range of returns and holdings as well. So our Sydney Airport, that's obviously a larger portion of the portfolio than Race, which is that high yield unrated bond.
So it's great to hear about those three bonds in that balanced portfolio, Jess, but can you give us an idea of the sorts of returns you can get from the conservative right through to the high income or high yield?
Yeah, sure. So, like I said, conservative, as the name suggests, it's probably for an investor, or it's for an investor that has a lower risk appetite. And yet the return on that is quite attractive. That's 6.13% on that. It has 10 bonds in that portfolio, in this sample portfolio. It's based on a 500,000 investment. And that has 100% investment grade. So, when we're talking about risk return, 100% investment grade with a return of 6.13. I certainly would say that's quite attractive. Can't argue with that. And then when we talk about high yield, there's a bit more spice in this, right? So those are with the clients that maybe externally may have quite a large holding in term deposits. They already have their conservative exposure, and so they want their bond portfolio to have a little bit more juice in it. And so our high yield, just a sample portfolio, it has 16 securities. That's about 500,000 of investment, and that has a return of 9.63%. So certainly, if you've got concerns with keeping up with inflation, that's going to provide a really good cash flow for you, and that has an investment grade exposure of only 7%. And so the exposures within that portfolio certainly reflect that as well, as they do in the more conservative one. You'd have maybe a government or semi-government exposure in it, and it reflects that risk reward.
That's great. It's great to see those numbers. I'm surprised that you can get over 6% for an investment grade, 100% investment grade portfolio.
And Liz, that just goes to show as well what sort of bonds have been issued in the market at the moment, with interest rates being so high, that the opportunity that exists there, and you spoke earlier about, possible for recession, and that's certainly in the US, though that noise isn't as loud here in Australia, but certainly there is the potential for interest rate cuts at some point. There's talk of at the back end of this year, if we see that event rate maybe gets pushed into next year, but that does leave that window where these high returns can be locked in now, whereas if you do wait and see how the markets play out, that opportunity may not exist then.
I think that's very important that you're just touching on timing, because I had meant to raise that with you and I realise I haven't. Timing, it is important, but if you're not in the market, you can miss those opportunities. And look, I think over 6% for an investment grade portfolio is very attractive. It's interesting too. I've been looking at managed funds over the last few weeks, and your high yield portfolio is showing yields above a lot of those managed funds. So I think it's, if you're interested in getting into the market, it's well worth contacting FIIG. But Jess, can you just tell me, how would I, if I was interested, what would I do, and what would be the process in putting together a portfolio?
Yeah, certainly. So, first of all, certainly give us a call. We have offices in Brisbane, Sydney, WA, and Victoria as well in Melbourne there. So, certainly we are across Australia. So give us a call, first of all. We also do have seminars as well, which the introduction to bonds, where you can come along and find out. So, part of the journey of setting up a portfolio is just a bit about education and better understanding this asset classes. We have spoken, everyone is very familiar with, the shares and things like that, those other asset classes, property too, but less so about bonds. So, come along to a seminar and meet the team and ask any questions you have, and certainly find out more there is about bonds. We also have weekly and fortnightly publications as well, which are educational on a website called The Wire, which you can jump on and has a search function there. So there might be a particular topic, even that we've spoken about today, Liz, that you want to find out a bit more on. I'm sure there's an article on there. It's got a very vast archive there that you can search through and find out more on. But certainly to set up a portfolio, give us a call, tell us what you're interested in, and we can certainly send through a sample portfolio following that discussion and get started from there.
Jess, thank you so much for talking us through Investing Direct. I think it's a really important part. To me, it's sort of like the Rolls Royce of investing. You get to choose.
Well said, Liz.
Well, you get to choose the bonds you want. You have control. It does take more work and you do need to learn about it, but there's a lot of advantages there if you can afford it and if you have that level of interest. But thanks very much for speaking with us today, Jess, and hopefully we'll have you back again sometime in the future.
Lovely. Thanks for that, Liz. Appreciate it. Had a great time.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran and we'll see you next episode on Fixated, the Fixed Income Podcast.